take a look at the bond market here. You've got yields moving to the upside off the back of that better than expected CPI print, showing inflation perhaps decelerating ever so slightly here. You've got your 10-year yield now around 4.3%, up a few basis points from earlier in the week when we were hovering around 4.2. Now, today's action coming as bond traders increasingly signaling concerns of a potential recession. Here to discuss more with us, we've got Tom Porcelli. He's PGIM's fixed income chief U.S. economist. Tom, great to have you as always. What is the bond market telling you today? What are we expecting in terms of the Federal Reserve? And what does that tell us about the market as well?
Yeah, so good to be with you as always also. When I look at the market, I think the market is sort of conflicted here a little bit, right? You have to consider two important things from this CPI report that just came out a little while ago. One, it was better than expected, but this doesn't reflect tariffs, right? This is a reflection of what was. It's not a reflection of what is to come.
Right.
And so I think that's sort of tempering the market's reaction, which is why yields are up. I think the other thing you need to keep in mind too is that when it comes to CPI, really what we need are sort of the components within CPI that feed into PCE. And so when we look at those components that feed into PCE, it looks like PCE could actually be pretty firm. We're looking at about 0.3 right now. We'll firm that up after we get PPI tomorrow. So I think both of those factors, the reality of this report does not reflect tariffs, and it looks like PCE is going to be a little firm is what's driving yields higher.
So what end of duration, just to kind of get that question out the way, what end of duration should investors feel comfortable with at this juncture?
Well, when you say end of duration, you mean like sort of where across the curve should people feel comfortable?
Certainly.
Yeah. So, look, I would say it this way. If I look at like 2s and 10s, I think, 2s as always are going to be at the mercy of what's going to happen from a monetary policy perspective. Our view is that you're likely going to see cuts this year. I mean, we've had 2 cuts built in for this year since the beginning of the year, actually since late last year, and that's something we still expect. I think 10-year yields will probably be a bit more anchored, but again, I just want to be clear on this point. That assumes that we actually don't see the worst of tariffs. At the end of the day, wherever you're going to be across the curve is going to be, at the mercy of what degree of tariffs do we see, because I can make an argument if we do see some pretty aggressive tariffs that I actually think that would usher in a more aggressive easing cycle for the Fed. Everyone's talking about this impact on inflation, and I have a ton of sympathy for it. I mean, I think it will show up in inflation at first, but I think ultimately this will actually wind up biting growth. And so I can make an argument for the Fed to ease even more, in which case that's not priced into the market.
So do you think that there is evidence then, Tom, to support the idea that the Trump administration is okay with what they've said, causing a bit of pain, because then the Federal Reserve will have to cut and then that'll be a lift to the market?
Yeah, it's interesting. We were talking about this yesterday. I mean, people keep on wondering, what's the pressure point for the administration? I think everyone has been assuming it's the equity market. I don't know. I mean, I keep on hearing them talk about 10-year yields. And, the only way to bring down yields really in a sort of a practical sense in the near term is through the monetary policy channel. And so if all of a sudden things do weaken on the back of tariffs, it would usher in a more aggressive easing cycle, which again is not built into the market,
right.
Which is what you would get is how you would get a sort of a bigger market reaction in yields.
But isn't a recession also a way to get the 10-year lower?
Yeah, definitely. And just to be clear, that's exactly right. So you usher in a more aggressive easing cycle if tariffs do go through in earnest, because again, I think that's going to show up from a growth perspective more than I think from an inflation perspective.
Yeah.
And that's the magic, right? That's how you get yields lower. I don't know if that's necessarily what we should be cheering for. When you have a recession, it comes with job losses. That's the reality of recession.
And so if we did see a recession that fades, and that it's already started to fade, the U.S. exceptionalism trade, how has that started to get factored into what your team is kind of laying out in its own forecasts?
Yeah, it's an important idea, and this is something that we've been trying to drive home for the last several quarters. We think the left tail. So the left tail, from a probabilistic perspective, the left tail is sort of the downside risk, and so we've been saying that the left tail is pretty fat. because of all these risks on the horizon. So we definitely have a skew to the left as it relates to the backdrop. Again, we think that the backdrop, if you just take a snapshot in time today, the backdrop is actually moving along at a pretty good pace. It's just that we have now all the uncertainty associated with tariffs that is really, we think, going to weigh on economic activity and makes that left tail just a little fatter.